What's up, traders? Anthony Crudele here, and welcome to Futures Radio Show podcast on a Fed Day. And today's panel discussion is going to be how to use macroeconomics to be a better day trader.
So the chart on the left is bank failures sized in nominal terms. It is not adjusted for inflation, so that's an important note. The ones that are in yellow are the bank failures for the great financial crisis. The ones that are in blue are the bank failures we've had this year. So they are pretty big. I think if we adjusted for the sort of dollar power, purchasing power we had back in 2008 versus now, it would look a little bit different, but it's still noteworthy. It's also noteworthy because they're pretty large banks that are failing here. And some of these banks are failing simply because they had runs, right? There has been this discourse, Silicon Valley Bank was terribly managed, First Republic was terribly managed, and I get it, people have their critiques, but the reality is that about half of American banks are functionally insolvent, and if there was enough pressure from a run, really, as my partner Aisha says, no bank survives that.
Yeah, so, for me, everything's so price action based, but I also, taking the macro into consideration, there's always malinvestment always leads to bad investment. You have all this free money flowing around, as we've already talked about, and then it goes into whatever areas, Mayhem and I talked about before, they're so heavily invested in the crypto space, the crypto banks and all this stuff. If you look at who owns the majority of those, a lot of those are the big banks, the big institutions in the United States. So we just kind of have to know that they have some crap on their balance sheet. So I think overall, it's just understand that there's a lot of risk right now, and this could go a bunch of different ways. And we all have biases, but once again, nobody's gets it right 100% of the time. So you always have to be ready for the downside.
One of my good friends many years ago said to me, he goes, Anthony, technicals get me into trades, fundamentals keep me in trades. And when you look at it from that perspective, this is why the macro is so important. If you have something that's going on, that's news is driving the market, or you have, a data point or something that's happening in the market that on the bigger picture, the macro is shifting or it's continuing and accelerating a trend, then you don't want to fade that move. You want to be with your size on the side of the move. And so macro may not get you into good trades like technicals or other things that you're using on your charts, order flow, whatever it may be. But at the end of the day, you have to understand the context of these situations.
Basically, what we're seeing here is a sign that money is less available, right? And this goes across the board. I just chose this chart because it's representative of higher quality borrowers. So you're seeing even higher quality borrowers are having a harder time raising capital. And if they're able to raise capital, it's going to be at higher rates, right? So basically you have this dichotomy. Less businesses and consumers are able to get loans, and those that can are going to pay more for them. And this is a side effect of what the Fed's doing, but it's also what's happening in the banking system. So of course they have choices. They can raise deposit rates and try to attract more so they can rebalance their assets and liabilities. But on the other side of it, they're going to loan less. What happens if people start to look at passive investing with a little bit more skepticism? I think that that's the danger of this. We've got way too much concentration in too few companies. If you start to see that people lose a little bit of confidence in their leadership, that can have a pretty big drag effect on the market cap weighted indices. And I think it does make a bit of a case to look at A, different factors, maybe value instead of growth is a little more attractive, and B, different types of passive investing. Why not look at equal weight versus market cap weight as an option when there's so much concentration in the market cap weighted indices?
So for me, I always am wanting to look at, because if I am trading futures, I do need to pay attention to these stocks. What is going on with Apple? What is going on? Check out the charts, see if it's breaking down, see all these things are so important to the market now, because as we're looking at is a huge part of the market. And as the market becomes thin, think about it like a foundation. There isn't much holding up the foundation now. There's a bunch of twigs.
We're looking at new highs versus new lows on the NASDAQ, and we can see that new lows have been the dominant theme here. And really, this has been consistent since we entered a bear market. And we have these little head fakes up, as you can see. We have some new highs, and then we get back to these new lows. What is this telling us? It's another way of measuring breadth. And it's telling us there's not a lot of market leadership here, that there's still large swaths of the NASDAQ that are rolling over to new lows more than we're seeing new highs anywhere. And that's Not a great sign. That's telling me we're still in a bear market with a very powerful counter trend rally. And let's go back to the dot-com bust for one reason. Not to say that this is the same, but because the NASDAQ has been up more than 20% year to date, and some folks are saying this is a new bull market, let's just recall that after the dot-com bust, there were 6 or 7 times where the NASDAQ went up over 20% before it rolled over to new lows. And when it finally did bottom, it went sideways for about 10 years.
For me, a bear market or a bull market, that's the temperament of the overall market, and sentiment and everything needs to be in there for me to say this is one way or the other. This still feels like it's in between for me. And when I'm looking at breadth, I'm noticing, there was an actual great breadth thrust that was moving higher and higher and higher. And that was all the way into February. And then the bigger stocks started to pick up again. Now, those were lagging majorly before that. Now they're starting to pick up again, and we're seeing that those are leading the way. Now, if this is just a normal run, these are all going to continue to pick up, and it's going to wiggle between. I think that's very normal for a good bull market.
We're looking at systematic positioning in equities from CTAs, from risk parity and vol-controlled funds. We just mash them all together, and we can see they're very long. They're the longest that we've seen since 2021. And so if it's not a regime change from a bear to a bull, there may not be the same level of buying power. And what's interesting is that we have some convergence here, right? We have this large wall of calls at 4,200. We have the top of the trading range we've been in for the past year just at about that same level as well. And so you can kind of see some sense that, the idea that everyone's too bearish is not supported by the data.
So, sometimes you can be skeptical about it, but when you see it's this crazy and it's this high, that's something to really pay attention to, keep an eye on, and really, understand that, at a certain point, there's a lot to be sold. There's a lot to be sold off, and that can happen in a big way.
So we have money supply as measured by M2 falling year over year for the first time since the Great Depression. So it does have a lot of people concerned, and justifiably so. This is going to impact the amount of money that banks have to lend, how much people can pay back their debt, because obviously when you have interest on debt, that money has to come from somewhere. And if there's not as much money in the supply, people are going to struggle to pay that interest and that principal even more. And it also tends to slow the economy. But zooming out to the big picture, just looking at it in aggregate, we can see that we're starting to revert to a trend line. As the Fed and other central banks continue to tighten policy, and as banks pull back on lending, and it all kind of feeds into itself, right? Some of this money is brought into existence, it's lent into existence. There's going to be less of that as well. We're going to see on Friday, and really tomorrow with jobless claims, but Friday with non-farm payrolls, how much of this is weakness and how much of this are just jobs that were filled that we don't need to have those positions open for. But what we can say is, at least at present, the amount of jobs available for insured unemployed people seeking work is about 1.5 now. But it's showing us that the jobs market is not quite as tight as it has been, which is great news for the Fed, although they have a lot more work to do. The trend is going in the right direction, and that could be good news for inflation. Who gets hurt the most in tightening credit conditions? It's going to be these small businesses, because if they're lucky enough to get credit, they're running revolvers, which are going up. That means their interest rate's not fixed. It basically goes up as the Fed raises rates, plus whatever markup the bank has on top of that. But a lot of businesses can't get credit in this environment, or banks may even be pulling back credit. And that means they don't have the same funding for payrolls, for expansion, and so forth. So they're pulling back. Why does the Fed cut? They cut because something's going wrong. They don't cut because something's going right. Every time they've cut, it's because they're starting to see weakness in the labor market that concerns them more than price stability. Their real dual mandate is making sure that we have price stability and maximal employment. Well, we'll see what the unemployment data looks like on Friday, but for right now, we have historically low unemployment. The interpretation of the Fed, going all the way back to last year, is that they're going to imminently pivot. Like every time they hike, this is the last hike, we're going to get the pivot, everything's going to be fine, it'll all be puppies and rainbows, we're going to have a soft landing, and inflation's just going to take care of itself. I have a feeling inflation, unfortunately, will be a little bit more sticky, particularly in services, and that the Fed has a lot more work to do. That doesn't mean they have to keep hiking.
If I'm looking at a chart, I like to put everything kind of together. This is a good one right here. That's the CRB against bonds. This is the chart on the right. I want to be looking for, hey, I might buy oil here. Hey, commodities that are energy-based, growth-based, like copper and so on, I might be more interested in. And so then looking at, what's the environment during that time? It's very interesting to kind of just understand the grand scheme of cycles. Yes, they're not like, it's not something that's going to be perfect. And I'm not like Larry in the point where I'm going to have, a model that's going to tell me what I think it should do. I'm just going to kind of look at the macro and kind of the understanding that, for example, right now, bonds look okay. Tech is kind of taking off. Bitcoin is holding up decently. That kind of looks like an early cycle to me.
So it depends on what I'm trading. For day trading, I'm more macro agnostic. Like I certainly look at it, but I don't allow it to dictate what I'm trading. I try to remove all biases and just really follow price on shorter time frames. For swing trades, I like to use a macro overlay. It's not always necessary. We can see relative strength and relative weakness in sectors that are kind of giving us a sense as to what institutions are seeing and how they're positioning. So I would say for me, it's more of a case-by-case basis.
It's really interesting if you look at micro caps, small caps, energy stocks, gold miners, and so on. You see that they start to actually take off right when the money starts coming out of large cap growth space in the NASDAQ. But basically this chart kind of points to, is this kind of going the other way? Can we get kind of above that right shoulder that I'm kind of pointing at there? And if we do get above that, where exactly do we go? And will we see this kind of FANG leadership take over again? We talked about the cycle thing a lot. And I just wanted to kind of point out that that's exactly what we're kind of looking at. Money coming into gold, coming into bonds against commodities, coming into stocks against commodities, money going back into commodities as we get further out. That big peak in 2020 as we're seeing, and then that sell-off. And now once again, money's kind of going back into gold, the NYSE, and bonds. Most of the time, it's kind of funny because I know a lot of gold bugs who really hate tech stocks, but most of the time when tech stocks do well, gold tends to do very well too. And it's because yields are coming down. And that's a good way of kind of understanding yields and bonds for me, at least. If I'm looking at the 2-year, most of the time if the 2-year is starting to make lower highs and starts to turn over, especially as the Fed is still raising rates, most of the time at some point the Fed will catch up to that and stop raising rates as well.
In terms of the Fed meeting, I see the consensus view of 25 bips being the most likely outcome. I don't think they want to rock the boat. This has been one of the most transparent Feds I've ever experienced. And I mean, I was following the Fed all the way back to Greenspan. And he would just come out and just say gobbledygook. He would literally say, if you think you understand what I'm saying, then, I'm doing it wrong. You don't get it. I'm really trying to obfuscate as much as I can. And then we had Bernanke, and he was kind of that vein, but maybe a little more transparent, and Yellen. But Powell, especially since 2020, has been trying to get out in front and set market expectations very transparently. And while his economic guidance, and really the economic guidance from the Fed, is generally not great, whether it's inflation or their outlook of a soft landing or whatever, their policy guidance has actually been pretty spot on. I think they will continue QT at the run rate of $95 billion a month. I think they'll express concern about what's happening in inflation.
Number one, everybody, I put Jason's link to Twitter, which I recommend everyone goes and follows Jason today. And don't forget to get the chart deck today. All the charts that Mayhem and Jason put in there will be in that chart deck at anthonycrudele.com.
For me, this situation could go one of two ways. I definitely see that the market is in a space right now where we're kind of sitting right against resistance. And when I'm looking globally, though, at the same time, I'm also noticing that, some of these markets are making new highs. Globally, we're kind of in an uptrend in the developed market space. So I'm kind of seeing that there's contrast here and there's something going on somewhere. And most of the time, I'm going to look at that price action and keep that in the back of my head as maybe the market is noticing something that I'm not. Opinion doesn't matter. The fundamentals don't matter. Nothing really matters. I would really be interested to see what direction this goes. If it goes up, I want to be involved in that. If it goes down, I want to be involved in that. Sometimes I have to really take myself and my views out of things and just kind of take an understanding that we are in a tight liquidity environment. So I just want to participate any way it goes, especially as we're just in this very tight range right now. And either way is a great signal.
I've always said I'm not a macro guy, but I try as hard as I can to understand what's going on to help me become a better trader. And I think you guys did that very well for everybody today. So thank you both very much.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.